In August of 1971, the world learned that money could change overnight. Most people only saw a short announcement on television. Few understood that the rules of global finance had just been rewritten. Archived papers from that week show quiet confusion inside banks and trading desks. Some employees reportedly asked if the dollar would still mean the same thing by morning. The answer turned out to be no. The modern dollar that people use today does not follow the rules that guided it for most of American history. The money in savings accounts, the money in pensions, the money used for groceries, all of it sits downstream from a weekend decision made by a single administration in Washington. For many families, the change was invisible at first. Parents went to work on Monday. Children went to school. Shops opened normally, but something subtle had shifted. A link that had anchored global currencies for decades had been removed in one night. One retired bank clerk described that week years later. She said the office felt calm on the surface while the supervisors kept walking to the radio for updates. She remembered one line clearly. It was the first time she heard someone say that the world had entered a new monetary era. This moment matters because every dollar that moves through the economy today traces back to that break. The way interest rates behave, the way inflation rises, the way governments borrow. Each of these everyday realities started to change after that weekend. How did one announcement from 1971 reshape the financial world that people live in now? And what small detail from that night still influences the value of money today? The real story does not begin in 1971. It starts quietly in the late 1940s when the world was rebuilding after the war. Nations met in a place called Bretton Woods to design a financial system that could prevent another collapse. They agreed to anchor their currencies to the United States dollar. The dollar itself would be tied to gold at a fixed rate of $35 per ounce. This arrangement gave people a sense of stability during a time of uncertainty. Institutions like the International Monetary Fund and the World Bank were created to hold this system together. Their early reports from those years show confidence in a predictable structure. Many believed the arrangement would last for generations. But hidden inside these agreements was a pressure point. The stability depended on the United States holding enough gold to match the dollars circulating around the world. By the late 1950s, that balance began to slip. American spending rose as the country supported allies and funded domestic programs. European nations reportedly noticed that more dollars were leaving the United States than gold was coming in. Some central banks started to redeem their dollars for gold as the agreements allowed. A former French official later recalled a conversation from that era. He said a colleague quietly asked whether the gold behind the system could hold out forever. It was a simple question. It carried a warning that few paid attention to. When you think back to those early tensions, do you remember a time when something looked steady on the surface, but was already shifting underneath? These early cracks set the stage for what came later. By the early 1960s, the quiet imbalance inside the Bretton Woods system was no longer a theory. American gold reserves had fallen from more than 20,000 tons after the war to around 15,000 tons. At the same time, dollars held overseas grew into the tens of billions. According to archived Treasury notes, this was the first moment when officials realized that more dollars existed abroad than the gold that backed them. Insiders in Europe reportedly watched these numbers with concern. French President Charles de Gaulle publicly argued that the world should return to direct gold settlements. In 1965, France sent a naval ship to New York to collect its gold, a symbolic gesture that signaled a deeper mistrust. Other nations began to consider similar redemptions. In the United States, ordinary citizens rarely heard about these developments. Newspapers focused on domestic policies and social issues. But behind the scenes, central banks were moving steadily. A former American diplomat later recalled hearing colleagues say that the system was becoming a confidence game, though no one used that phrase outside private meetings. This was the first real shift in power. Foreign governments now held the leverage. They could ask for gold at any time. Each redemption chipped away at the balance that held the system together. Do you remember a time when a small number in a report changed the way you looked at an entire situation? These early redemptions pushed the United States toward a decision it hoped it would never have to make. To understand what happened next, you have to see how the system actually worked behind the curtain. Bretton Woods looked simple on paper. Each country fixed its currency to the dollar. The dollar stayed fixed to gold. But the machinery holding this structure together was far more fragile than most people realized. Every dollar overseas represented a quiet promise. If a country brought that dollar to the United States, it could redeem it for a small amount of gold. This promise worked only as long as few nations actually used it. According to archived Federal Reserve memos, the system depended on confidence rather than daily transactions. By the late 1960s, that confidence was weakening. United States spending increased through the Vietnam War and new social programs. More dollars flowed out of the country. Gold reserves did not rise to match them. This gap created what some insiders reportedly called a pressure valve. If too many nations demanded gold at once, the system would collapse. One illustration from that era involved the Bank of England. It faced its own stress during a currency crisis in 1967. British officials asked the United States for support to maintain their currency's fixed rate. A retired staff member later said the request showed how dependent the world had become on a single pillar. That pillar was starting to shake. For many people, the mechanism was invisible. Paychecks came on time. Shops used the same prices. Nothing looked urgent on the surface. But the numbers behind the system were drifting in a direction that no central banker could ignore. Have you ever seen a situation where the structure looked stable simply because no one tested its limits? Those limits were about to be tested in a way that would change the global financial order. The strain inside the system did not break all at once. It unfolded slowly through the late 1960s in ways that most people never noticed. By 1968, the United States gold stock had slipped below 10,000 tons. This was the lowest level since the early 1930s. Archived congressional reports from that year pointed to an uncomfortable truth. There were now far more dollars in foreign hands than the gold available to redeem them. Central banks reacted cautiously. According to European records, several countries began discussing whether the United States could maintain its promise at all. A few reportedly moved to exchange larger amounts of dollars while the window remained open. These actions were not dramatic. They happened quietly. But each redemption chipped away at the foundation. For everyday Americans, the consequences appeared in small ways. Prices started to rise faster than people were used to. A gallon of gasoline that had held steady for years began creeping upward. One retired hardware store owner remembered adjusting prices twice in a single season for the first time in his career. He said he did not understand the cause. He only knew something had changed. Insiders in Washington allegedly saw the numbers tightening like a vice. They feared that one large request for gold could trigger a chain reaction. The entire post-war financial structure depended on avoiding that moment. Have you ever watched a problem grow slowly until it became impossible to ignore? By 1970, the quiet tension had grown into something none of the architects of Bretton Woods expected. By 1970, the pressure inside the system was no longer hidden. The United States was running a growing budget deficit. Imports were rising faster than exports. Foreign central banks held more than $40 billion. A figure that far exceeded what American gold reserves could support. According to archived accounts from the Federal Reserve, several European governments began meeting privately to discuss a coordinated redemption of dollars for gold. The idea reportedly worried United States officials because even a partial move could empty the Treasury's remaining stock. Confidence, the unofficial glue of the entire arrangement, was slipping away. The numbers told a clear story. In 1970, the United States had about 9,000 tons of gold left. At the same time, global claims on that gold had become several times larger. Each month, the imbalance widened further. Behind the scenes, individual countries were making subtle moves. West Germany allowed its currency, the Deutschmark, to rise rather than continuing to defend its fixed exchange rate. This signaled that the old rules were losing their authority. Japan reportedly considered similar steps as its trade surplus grew. One small anecdote from that year came from a former Treasury staff member. He said the office kept a chalkboard showing daily gold flows. Some days the totals were modest. Other days the numbers erased an entire week's stability. He remembered colleagues speaking in quieter voices as the redemptions increased. Do you remember a moment when a situation began to accelerate faster than anyone expected? This rising speed pushed Washington toward a decision that would define the modern financial world. The breaking point arrived in the summer of 1971. The imbalance that had been building for more than a decade could no longer be managed with small adjustments or diplomatic meetings. Foreign central banks were redeeming dollars for gold at a pace that alarmed officials in Washington. Archived internal estimates from that period show that at the existing rate, the United States could have run out of freely available gold within months. In early August, the United Kingdom sent word that it intended to convert a large amount of dollars into gold. According to later accounts, this request was large enough to threaten the remaining reserves at the Treasury. Officials reportedly described the situation as untenable during closed-door discussions. For the first time, the risk of a run on American gold was no longer theoretical. Inside the White House, the mood shifted. President Richard Nixon and his advisors met repeatedly over a single tense weekend. Notes from those meetings show concern over inflation at home, rising unemployment, and the belief that foreign governments were taking advantage of the fixed system. They debated several options. Some involved temporary controls. Others involved a full suspension of gold convertibility. One eyewitness-style detail came from a staff member who recalled watching aides move in and out of the cabinet room, carrying new data sheets every hour. He said the atmosphere felt unusually quiet, as if everyone understood that the decision reached that night would reshape more than a domestic policy. Have you ever seen a moment when one choice became unavoidable, even if no one wanted to say it aloud? By Sunday evening, the administration settled on its path, and the world was about to enter a different monetary era. When the announcement came on August 15, 1971, many people saw it as an emergency measure. Few realized that it revealed a pattern that had repeated itself across history. Whenever a currency is tied to a scarce anchor and the amount of money in circulation grows faster than the anchor itself, the system eventually breaks. It happened with the British pound in the early 1930s. It happened with several European currencies in the 19th century, and in 1971 it reached the United States. The pattern is simple when viewed from a distance. A country promises that its money can be converted into something real. The world trusts that promise. Trade expands. Debts grow. Governments spend more. Eventually, the claims on that real anchor become larger than the anchor can support. At that moment, the promise becomes impossible to keep. Archived studies from earlier eras show the same cycle. In 1819, Britain suspended the gold standard after the Napoleonic Wars drained its reserves. France faced similar strain in 1936, when its gold stock fell by more than a third. Each time the system held until the pressure reached a point where conversion was no longer practical. One thoughtful observation came from an economist who lived through the Nixon years. He said that the world always believes each version of the system will be the last. Yet the underlying forces remain the same. Do you see how a pattern can stay hidden until you step back far enough to notice its shape? Understanding this pattern helps explain why the events of 1971 were not an isolated crisis but part of a repeated global cycle. The decision made in 1971 did more than close a convertibility window. It reshaped the way money works in everyday life. Once the dollar no longer needed to match a fixed amount of gold, the supply of money could grow in new ways. This shift influenced prices, wages, savings, and the global financial system that people use today. Inflation began rising through the 1970s. According to archived consumer data, the cost of living in the United States nearly doubled between 1971 and 1980. Families who had once relied on steady prices now watched groceries, fuel, and housing climb faster than their paychecks. Pensions and savings accounts that had seemed safe lost purchasing power year after year. Governments also changed how they managed their finances. Without a gold constraint, borrowing became easier. United States federal debt, which stood at about $400 billion in 1971, eventually grew into the trillions. Other nations followed the same trend. The global economy shifted from a system built on metal reserves to one driven by credit. Modern markets were shaped by this new flexibility. Interest rates became the main tool to guide economic stability. Central banks gained more influence because they could expand or contract the money supply based on policy rather than metal reserves. A former Federal Reserve governor once remarked that 1971 gave central banks a steering wheel they never had before. For ordinary people, the consequences show up in familiar moments. Paychecks stretch differently than they once did. Mortgages depend heavily on interest rate changes. Retirement planning requires understanding inflation in a way earlier generations did not. Each of these daily realities can be traced back to the shift that began more than 50 years ago. When you look at your own financial life today, do you notice how many parts of it depend on policies rather than physical reserves? This long chain of effects leads directly into the final perspective on why those events still shape every dollar used in the modern world. When you look back at August 1971, it can seem like a distant historical footnote. But the decision made that weekend created the monetary landscape people live with every day. It marked the moment when money shifted from something anchored to a fixed resource to something guided by policy decisions. The world moved from a structure of limits to a system shaped by constant adjustments. One echo from history comes from the period after Britain left the gold standard in 1931. Archived reports show that financial markets struggled at first, but eventually adapted to a new kind of flexibility. The same pattern followed the Nixon decision. Markets hesitated, then discovered they could expand without the constraints that had shaped them for decades. Understanding this moment helps explain why the value of money today depends on trust, cooperation, and policy rather than metal reserves. It also explains why modern economies can respond quickly to recessions yet remain vulnerable to long cycles of inflation and debt. The choice made in 1971 was not framed as a rewrite of the world's financial rules. Yet that is exactly what it became. It set in motion a system where every dollar reflects confidence rather than convertibility. When you think about the bills in your wallet or the numbers on a screen, have you ever wondered how different they might look if the world had never taken that step in 1971? This is the question that leads into the final reflection on what this change means for the decades ahead. The story of 1971 is not only about economics. It is about how a single decision can ripple quietly through decades. Most people never felt the moment when the old system ended. They only lived through the world that formed afterward. Looking back gives us a chance to understand why money behaves the way it does today. Why prices drift upward year after year. Why governments rely on borrowing more than reserves. Why confidence has become the backbone of the modern financial system. When you think about your own life, have you seen moments where a quiet change ended up shaping everything that came after? If you enjoy stories like this about the hidden patterns behind major events, you are welcome to join us here again. There are many more chapters in financial history that help make sense of the world we live in. Thank you for spending this time with me today.